Guys, guys, I did it. I ended up selling everything. It's gone. It's all gone. I sold it. I'm just kidding. I didn't sell everything. But if before you hit that dislike button, now I got you in here. I want to go over when to actually sell a stock. People know when to buy a stock, but a lot of people don't know when's the right time to sell a stock. So today I'm going to go over a couple of notes here on my iPad about that topic. So sit back, relax, take a sip of your coffee, go down below, get your $50 from M1 Finance, limited time. All you have to do is use my link, deposit $100, and we each get $50 to invest with. And you guys could check out my Patreon if you want all my real-time buys, sells, call outs, a morning update video, and more access to me. All of that's on Patreon, link down below. And with that being said, let's get right into the video. So, when do you sell a stock? When do you sell a stock? A lot of people cover the technicals on when to buy a stock, the technicals on when to, add more to a stock, but no one talks about, on a fundamental basis even as well, when to sell a stock. So we're going to break that down today in a quick little 5-10 minute video. So number one, when to sell a stock, when there's a fundamental shift in the company. That's number one. Sell a stock when there's a fundamental shift in the company. So what the heck does that even mean, right? The moat is no longer there. When you look to invest in a company, you want to invest in something that has a moat. And what that means is it has a distinct competitive advantage that is very difficult to replicate, if not dang near impossible to replicate, right? And once you see this moat no longer there, that is a reason to invest right off the bat. So let's say, for example, Tesla is selling electric vehicles, right? They're leading the autopilot race right now. They have the best autopilot by a mile. But let's say 5-10 years from now, every car company is doing autopilot. They're better than Tesla when it comes to that. Let's say their cars are better. That would be a fundamental shift in the company that doesn't really warrant you holding the stock anymore. That would be a huge shift, and the moat that Tesla has is no longer there. So that's one example, right? And let's say another example is Apple's iPhone. You all know the ecosystem that Apple has built, from the iPhone to pairing your iPod, or what the heck are they called? AirPods, to the iPhone, you using Apple Music. Let's say this ecosystem was somehow disrupted, which I doubt will ever happen, hence why Apple's very strong moat. But let's say it was disrupted. That would be a fundamental shift in the company to where it might be a good idea to sell, maybe not all of your position, but a decent amount of your position. And another point here worth mentioning, tip number 2, is when your stock has reached your target price. So important, guys. People blindly buy stocks these days without A, looking at valuation, which is such a big mistake, and B, without having a target price. That's like, it's ridiculous. It's like buying something and not knowing when you want to sell it. That's exactly what it is, and that's what people do these days in this market that, quite frankly, we've looked at the Shiller P. It's very high. It's at the dot-com levels, dot-com bubble levels, and quite frankly, the markets these days are a little bit frothy, and that's concerning, especially because people have no idea that the markets are frothy. Well, some do, some don't, and they don't know when to sell. So number 2 here is when your stock has reached a target price, whether that is technically speaking, whether that's based on fundamentals. And a lot of people, the way they figure out what price to sell at is they run discounted cash flow models. They use PE as well to, branch out the earnings, over the next 5-10 years, and they come up with the price. So let's say, for example, and I probably should have made an example on Excel to show you guys, but I didn't. But bear with me here. Let's say, for example, Facebook stock is expected to grow, or not even the stock, the company itself is expected to grow 10-15% over the next 5-10 years. You're going to use PE and free cash flow and revenue to figure out what the price will be in 10 years, and then you're going to reverse engineer it to figure out what you want to pay today. And for example, if the stock is way overvalued today, maybe you'd want to sell a little bit of it, depending on where you got in. So a lot of people use these different types of discounted cash flow models to come up with the price in the future to where they'd want to sell, if that makes any sense. I don't want to get too complicated in this video, but the moral of the story is, for tip number 2, is to have a target price, and don't be scared to sell when it hits that price. And let's say, for example, you got into a stock, and this is another great example here, especially for smaller cap stocks or even large cap stocks these days. I mean, they've been 3-4xing over the past couple of years. So let's say you invested in Adobe, for example, and Adobe went from $200 3 years ago, literally. Now it's $600. So let's say you bought Adobe at $200. And you doubled your money. One thing you can do here is, and this goes with any stock out there, guys, and by the way, this is not financial advice. You must always do your own research. But let's say you doubled up your money. What you can do is take out your initial investment and play with what people call in the stock market here house money, right? You can play with house money. And what that means literally is you're playing with the gains that you made on your initial investment. So let's say you invest $1,000 in Adobe, you make $3,000 off the investment, or let's say you doubled up, now you have $2,000. You take out your initial $1,000 and you're left with the remaining $1,000, which is house money. I mean, it's still your money, but it's the money that you made off the investment that you can just let ride, for example. You know, that's another way that people look at it. So, and that's what I've done in the past. You know, with stocks that have doubled, you know, I've sold a little bit and let the rest ride. And if it gets ridiculously overbought, overvalued, frothy, you could just sell out of the entire position. And of course, that is a decision that you as an investor, as a trader, you must make. And we've seen many times, time and time again, management teams screwing things up. That's another point. Point number 3 and the final point for this very quick video. If you see management steering the company in the wrong direction, they're making mistakes. And, you know, another big thing here is management, they might not have the right incentive, or not the incentive. They may be screwing over investors. Let's put it that way. You know, we've seen what happened. We saw what happened with Nikola. You know, if you see management not making the right decisions, they're being shady. You know, they're selling a lot of shares in the back end. You know, trying to keep it low key. They're selling a lot of their shares. That's not good. What you want in a management team, and this is so important, guys, listen up here. What you want is their compensation to be tied with the success of the company, because that gives them incentive to obviously do well, make the right decisions, and thus make money when the stock goes up, right? You don't want them to make money regardless, and that's just I was about to cuss right there. A crappy, you know what I was about to say, a crappy situation that you know, could put shareholders in a bad spot, you know, because if the management, their goals, their values aren't aligned with making money for the company and thus returning money to the shareholders, that is a huge storm that would not be good. Let's just put it that way. So that should have been number 1, to be honest. Well, moat is important and the price is very important, you know, selling at an overvalued price. But, you know, just management in general, guys, you got to keep an eye on them, because they could be buying mansions with the stock money they're selling. They don't care about the company, kind of like what Trevor Milton did with Nikola. This guy bought a $50 million mansion. You know, he was selling stock left and right. That is not something you want to be a part of. You want to be a part of a company where the management team has their head on straight. They're not selling stock left and right. they are being compensated from the success of the company, and their success, their individual success, is tied to the success of the company. And you have to look through the 10Ks, the 10Qs of different companies you're looking at, and look at the reports to see how management is compensated. That's very, very, very important. And maybe I'll make a video on that in the future. So overall, guys, that is what I want to cover today. And no, I'm not selling everything. I kind of clickbaited you all. I'm sorry. But you got to do that on YouTube sometimes to get the message across. I hope you all enjoyed the video. If you did, hit the like button, subscribe, make sure to drop a comment, and check out my Patreon. If you guys want all my real-time buys, sells, call-outs, a morning update video, all of that's on Patreon, link down below. And don't forget to get your $50 from M1 Finance and your 2 stocks from Webull up to $1,600. All of that free money is linked down below for you as well. I'll catch you all in the next video. And by the way, guys, I've made 4 videos in a row, hence why I've been wearing this shirt. You're going to see this shirt a lot because I'm going to Las Vegas, and I'm prepping a bunch of videos in a row here for all of you. And this is my 4th one in the past hour and a half. So we're knocking them out, guys. So I'll catch you all in the next one. Thanks for watching again. Keep crushing the markets. Peace out.